Everything you need to know about products and services that can improve your life. This is Experts on Call on CL 650.
You paint by numbers. I never noticed it before.
All right, we are back. This is StrataLife, part of Experts on Call here at CL 650. I'm George Gordon. Joining me in studio, Dan O'Hearn from Key Pacific Property Management, Dan Schmidt from Remdahl Painting and Restoration, and Ali Mohammed of Paramount Financial Services. Let's talk about the things you need to know about financing options. Ali, what are some of the things to consider, like amortization, rates, terms, fees, length of the application process? Perhaps you could give us a 101 on the things that we need to know.
Wonderful. Thank you, George. A lot can be said about these things. I'll just give you a top-line view so we can cover some of the different points that you've raised. First of all, it's important to understand that a strata corporation has the ability to seek external financing. This is financing for the purposes of capital upgrades and building remediation. So essentially what a strata corporation can do is seek financing from a bank or a private lender for the purposes of building remediation and or upgrade. So those options are there. So if a depreciation report says, you know, there's $3 million worth of work to be done immediately, it's not the end of the world. There are financing options that might be suitable to assist with that undertaking.
How much of a strata project can be financed? 100% of it?
Yes, so up to 100% can be considered. So we look at different elements of the scope of work, and quite often a strata corporation will come up and say, look, the initial scope is $3 million. We may have $1 million. Can you look at 2, or can you look at all of it? So depending, and it's case by case, but generally we can consider up to 100% financing through our lenders.
So how does a strata qualify for financing? Let's talk about the owner's personal credit and income.
Right. Good question. We typically do not look at individual owners' income or credit. We look at the strata corporation as the borrower, and we qualify the strata for financing based on how it is run, how it is managed, what sort of financial records it keeps, what sort of external property management it has, etc. So that information is critical when we review financing, but we're not relying on individual owners' income, personal credit reports, etc. to qualify a strata for financing.
And yeah, you know, George, you pointed at me. You thought I might have something to say.
I thought you might.
I mean, we've used these. Our first preference, of course, is a special levy upon the owners, or money from the CRF, because it's quick and simple and easy. Right. But on the financing side, we've certainly used that in buildings where, you know, the economic demographics of the ownership is such that they would struggle to get a loan, especially if you're talking about maybe a $10,000 levy or more, right? They didn't have that ability. Or we've had situations where they had to use the loan for legal defense because the building was embroiled in legal issues. The lenders were very hesitant to lend and on an individual basis. Right. So collectively, you're getting the assurances or the assignments of the strata maintenance fees for the loan, and it's very secure. I don't know if there's ever been defaults.
Even. Yeah, I haven't heard of much default, but we're getting the assignment of monthly maintenance fees as well as the special assessment for the financing. Yep. So there's an added levy to cover financing costs.
Yeah. So it's worked out well in some particular situations, definitely.
Right. So, you know, Dan, for smaller assessments, if it's, you know, if Dan Schmidt's called in to do some simple painting and the individual assessment is a few $100s or a few $1,000s, typically that's self-financed.
Yes.
We get into the capital upgrades, the larger capital upgrades, where the individual assessment is $10,000, $20,000, $50,000 per unit. I'm working on one which is $100,000 a unit at the moment. So it's a tremendous amount of money.
Wow.
Not everyone has that in their back pocket.
Right. Yep.
And nor will a bank finance a building that's in a deferred state of maintenance.
So what do you use as collateral? Accept as collateral?
Okay, so the security for strata financing is essentially, we get into a loan agreement which spells out terms and conditions of financing. There's a borrowing resolution that must be signed by the strata corporation, and every lender has their own resolution. We get into a general security agreement, and then we get into assignments of maintenance fees and insurance and certain undertakings to stay within the approval framework, and then legal opinions are issued by the Strata's lawyer for the purposes of financing. But important here is this: we're not putting a mortgage interest on each and every unit. And that question comes up over and over again. We are not doing that because every unit is probably encumbered already. But what we're doing is taking general security over the strata, and there's not an individual registration in every unit.
Important issues for the strata holder, for the strata councils, and the management companies. If you would like more information about some of the things that we're talking here today, StrataLife.ca. And you can hear the show in its entirety. We'll put it on our blog at CIL650.ca.com. Don't make that mistake again, .com. CIL650.com. We have the answers for you there.
And strata.life.
Strata.life.
Not .ca. Okay.
Boy, I am going to fail
Lots of dots,
webmaster.
man. What Ali was saying too, it triggered a thought. It's important that corporations understand when they approve these loans, it's for the entire corporation. In the past, there's been this thought: if I don't need to borrow the loan, I won't participate in the loan, and I'll just pay my amount. It's all in. We can't separate it out, because even if you were to pay your share, you're still encumbered by the obligation of the corporation based on your unit entitlement. So everyone's in or everyone's out.
Everyone's in by way of obligation.
Yep.
You can pay your own share, and quite often that happens, but that does not exclude you from the obligation.
The obligation if your neighbors don't pay.
Right.
Yeah.
Right.
What happens at the end of construction? Can the loan be reduced before term financing is committed?
Right, absolutely. So let's say that we have a $3 million scope of work. We managed to do it in $2.5 million. We're done. So now we've got $500,000 extra. That typically can get applied to the loan and get it reduced. But now you've got a fully improved building as well. So what an individual owners can do is go to their own bank and get their own financing for their unit, which again reduces the loan amount. So the short answer is you can reduce the loan amount before you negotiate fixed terms for the loan.
All right. So what is the broker's role in the loan? What is the process? How does the communication go on? What are the information meetings?
Right. So we first want to get to know who the client is. Who is what sort of strata corporation are we dealing with? Is it a low-rise, high-rise? Where is it located? How many units do we have? Is it rental versus owner-occupied? And then we get to learn about the strata council. How involved are they on a day-to-day basis? Is there external property management, the likes of Key Pacific? That's an important element in the overall look at the deal. We look at what sort of financial statements they have. What does their operating budget look like? What is the monthly cash flow management look like? Are the monthly maintenance fees on time? Are they being paid on time? Are they collected? If there is an arrears, how is that being dealt with? So all of that gets looked at when we look at financing. And if all of that kind of checks out, we then get into reviewing of documents, depreciation reports, financial statements, minutes of the strata, etc. And then we formulate a financing package and or write-up for lenders for review of the financing.
So what's the chain of command here? Does it land in the lap, Dan O'Hearn, of the property management company, and they pass it on to council, and council decides how that is then filtered down to the strata holders?
Well, I mean, ultimately the corporation or the councils recognize that certain capital projects need to proceed. There's an understanding of whether this is going to be done by a levy or not. If it is financing is chosen, there'd be normally proposals would be requested, reviewed by the corporation, brought forward to the ownership to approve, and then it would be subject to vetting by the corporation's lawyer to make sure that all the terms and everything are in place. And normally the lead-up time, I don't know if we've mentioned it, but how much lead-up time do you need
that's a
before
very
funding?
good question. Initially when we get into the consultation with the borrower, that's the easy part, because we can quickly vet through the initial information. And if we get a full set of documents, we can, within 2 to 3 weeks, give you an idea of what's available for financing. The difficulty is getting all the owners on site with the scope of work and who's going to undertake the proposed upgrades. And then this has to be voted upon. And there's always a pushback for large upgrades to any strata corporation. So, the larger the scope of work, the more resistance we see from ownership. So that's where the timelines get extended typically. But other than that, if we can get information that we need, we can give you a fairly quick answer as to what may be available. And then the lender will issue a proposal for financing with its own requirements. And once those are met, a final decision is made within a few weeks. So that in itself is not time consuming, but the scope of work, the agreement of the scope of work, who are the project managers going to be, who are the engineers going to be, who are the trades and sub-trades going to be, how qualified are they to actually do the work, and are the owners on side? And if there's pushback from the owners, then that's where the timelines get extended.
There is a term that I use often when talking about strata and work and whether to do it or not. It's called pay me now or pay me later.
Right.
Is strata insurance affected by a loan? Do lenders require strata to have specific insurance?
Yes, they do. And a lender will have essentially what is the current coverage that a strata corporation may have. It's an expanded version of that covers the construction insurance and the related liabilities that go with that. So basically the current insurance is expanded upon to meet the lender's criteria.
All right. Question for Dan Ahern on strata financing. What are the options if we don't borrow enough to complete the project?
Yeah. Well, I guess first rule of thumb is borrow enough,
Right.
because what you don't want to be, there's going to be a realization if it's some of these projects might be 6 months or longer, right? And there's going to be draws happening all the time. So it's really important to be in communication with your supervisor of that project to make sure that it's going to be on budget. And if it looks like it's falling short, you need months, at least a minimum of 1 month lead time. And then the corporation would have to have a general meeting called upon and look at expenditures out of either the CRF with approvals or a special levy, or perhaps, I don't know if the loans could be revised and increased.
Right. So what we do at the outset is we try on a best effort basis to not run into that.
Mm-hmm.
So the large, the scope of work is supported by tendering, the tendering process. And once a budget is formulated, it's vetted by a third-party cost consultant, a quantity surveyor. And then we build on top of that a healthy contingency reserve. So if there are any unforeseen expenses, we typically are okay because we've got a budget that's fairly well padded. And then at the end, if there's any extra, we reduce the loan. But we try and do a lot of homework at the front end in terms of vetting the numbers.
All right.
Yeah.
And maybe, Dan Ahern, just a note from you. This, I think in every building, it's going to be how much, it's going to cost me this much. I would think in your role as the property manager, it's if you understand that the painting's got to be done, the caulking's got to be done, this major project has got to be done, you have to still do a sell job to these people, even though you can't let them hide from it.
Yeah, and like Ali said, it's vetted enough that you know what the costs are going to be. People have to understand just because you're approving that loan amount or approving that special levy amount doesn't mean you're going to spend it all.
Right.
It's very easy to give the money back to people.
Right.
It's very hard to ask them for more. So you got to go into these things properly capitalized.
Right.
All right. We're going to end this segment right for now, but when we come back, we'll talk more about the issue of doing proper work on your strata, getting it done right, getting it financed right, not hiding your head in the sand and listening to your management company. You hired them to make sure they do a good job for you. Some of the other things that you can run into is coming up on StrataLife and StrataLife.ca.
No, just Strata.life.
Just Strata.life. Edit. Strata.life is where you can get a lot of these answers. This is George Gordon, and this is CIL 650.
This is Experts on Call on CIL 650.